Hello and welcome to another episode of the Investing with IBD show. This is our show where we talk a lot about Investors Business Daily, our methodology, and we have some great guests on to kind of share their thoughts on what's happening with the stock market. Today is May 28th, 2025, and we've got a special guest for you today. He's known as Follow Through Day Fahmy because it seems like every time he's on, we get a little follow through day action, but it's almost like we didn't need you this time, Joe. So, of course, Joe Fahmy is from Managing Director at Zor Capital. Welcome back to the show, Joe.
Thanks so much for having me on. We got an additional follow through day yesterday in anticipation of me being on.
So you know what, I think that's exactly what we were looking at. Whenever we get those strong days, Fahmy's got to be just right around the corner. And of course, because of that, it's probably a good time to talk a lot about follow through days and these signals that we use to get us back in the market. But kind of first, I want to just kind of pick your brain a little bit. It was such a dramatic drop that we saw. And, first you had kind of the December 18th, and I'm just going to pull up a market surge chart real quick to kind of go through this and make sure we're all on the same page. This is the NASDAQ composite. So, just as a reminder, we had this December 18th kind of jolt with the Fed. It wasn't what they did. It was kind of what they said. We had DeepSeek in here on January 27th with a big hit to AI. And then I don't know what the news was exactly, but February 21st really seemed to be where a lot of things fell apart. Of course, we had in here a lot of tariff talk, whether it was the Liberation Day or the pause on April 9th, a lot of volatility. How do you handle things when you get that dramatic of a drop, and how do you just not, think to yourself, it's time to buy canned goods and never invest in the market again?
I think we have to put a little bit in perspective of coming off of the lows. We had two amazing years in 2023 and 2024. So when you have back-to-back over 20, 25%, whatever they were each year on the NASDAQ S&P, I actually put it even on my blog to start the year for my preview for 2025, basically saying keep your expectations realistic, and I wouldn't be surprised to see a 10 to 15% correction in the first half of the year. Now, all right, I got lucky that I called that, but the whole point is even after big moves like 2003, after a huge move off of the lows, you had a 9-month consolidation in 2004. So off of these moves, a consolidation or some sort of a correction is actually not that surprising considering the big move that we had. Like you can see there, in 2004, we just went sideways for a bit. After that big move in 03, we just went sideways for a while. So it doesn't have to be a bear market. It's just the whole concept is after a market or a stock makes a big move, don't be surprised to see some sort of consolidation, correction, digestion, which in my view is actually pretty normal.
Yeah, and part of this is that you've not to make any age jokes, but you've been around for a while, so you've seen a few cycles, and so you kind of know what's normal. I'm going to reset it to today and just even back up a little bit more to this monthly chart, because at the end of the day, on the monthly chart, this kind of looked like nothing, in the overall scheme of things.
Yeah, just the velocity of the move scares people with machines taking over and program trading and so forth. So it just people, I don't want to say anyone enjoys a decline, but no one really likes a really fast, swift decline like what happened in March of 2020 when we dropped over 30% during COVID, or, what happened recently. So it was a quick decline. I'm not saying I expected it. I just wasn't surprised to see. I didn't know the reason. Nobody knew at the beginning of the year, but I just wasn't surprised to see some sort of digestion. And in a little way, there's some psychology behind it because a lot of people came into the year with huge expectations because of one thing, and one thing mainly is recency bias. So when things just go up and that's all you're accustomed to, we as humans tend to think they're just going to go up forever. And I think the market had a convenient way of unfortunately keeping the bulls in check and shaking out some of that excess bullishness.
Yeah. And it's so interesting you bring up the psychology part, because as much as a lot of us love looking at charts and stuff. It really, the psychology part, I mean, in some ways, that's what is shown on the chart. It's shown when things kind of get a little bit extended beyond their norm, a little bit beyond the mean, the average. So we talk about mean reversions, but there are those elements of expectations, I guess, from your average person, and it's the sum of those thoughts and feelings and emotions that really go into the market. And sometimes it's easy to forget that.
Yeah, it's very simple concept of human behavior. When things go up, for the most part, we tend to get pretty bullish, and when things go down, we tend to get scared and get bearish. And that's to your point, the Jesse Livermore line of nothing's changed over the past 100 years. The same human emotion of fear and greed that existed 100 years ago exists today and will exist 100 years from now. So it's not the main thing that drives the market, but it's definitely something that a lot of people don't give enough credit to. When one of those surveys, I forget which one it was exactly, coming into the year, had the highest number of people expecting a double-digit gain coming into this year. It was the highest ever. So, again, that just sort of showed you where the sentiment was. Because 2023 and 2024 were so strong, some people forget that the market can actually correct.
Right. And yeah, that's certainly, the market is there to remind us. And of course, Jesse Livermore, the wise words that you quoted, those were made 100 years ago. So it is interesting to that point. And for as much as people wring their hands about algos and program trading and whatever, at the end of the day, there is a lot of human emotion still in there, because look, the algos, they're programmed by humans.
It's a great point. Who programs the computers, right?
Right. So you can't really get away from that human thought and human belief. But you also mentioned kind of how bullish people were, but I was a little surprised at how quickly they turned bearish. I mean, it was some very quick. I mean, even before things got ugly, it seemed like the bearishness really took hold in terms of investors' intelligence, your AAII, your CNBC fear greed. A lot of those things seem to get bearish awfully quick. Is that something you've seen before?
I think it's two factors. I think, as I mentioned, the velocity of the drop, because after 2003 on the S&P, we just went sideways on 2004, and it wasn't a velocity. It was just sort of not more than a 10% correction. So I think number one is the velocity of the drop. And the second thing is politics, because there was obviously a lot of what sparked this drop and the gap downs and the volatility were tariff headlines. And this is where I'm reminded of that's the 2004 in the S&P. You can just see it went sideways. It wasn't a big velocity drop there. But going back to the politics part, I'm reminded by Warren Buffett's line, which is, when you mix your politics with your investing, you're making a big mistake. So I don't want to get political about this, but clearly the elephant in the room is, if you don't like a side or you do support a side, it sparks a lot of emotion, and people start to maybe sell because of their political beliefs, which I agree with Warren Buffett is a big mistake.
Yeah. So of course, a lot of times when we talk about the pitfalls of emotions, we kind of have, okay, what is the way to combat that? What is the way to overcome those biases, recency bias that you mentioned, the political bias that you might have? What's your go-to?
Turn off the news and turn off social media. Done.
Okay. But then also we rely on rules a lot of times. It's kind of those things that you come up with to combat that. And you've shared some slides with me that I want to also share with our audience about some of the, I guess, unusual aspects of this most recent rally that we've had here in April. So I'm going to share some slides here on our slideshow.
Yeah, while you're pulling that up, I mean, just as far as like combating the emotions, I think one word is acceptance. Accepting. I mean, you did allude to, I've been trading almost 30 years. So accepting cycles of the markets, like Peter Lynch has talked about, bull markets, bear markets, corrections, accepting that that's going to happen. And the second thing that comes to mind is knowing your time frame, because that can help reduce those emotions when you understand your time frame.
And just so people understand your time frame, what kind of time frame are you looking at, Joe?
I like to trade those power trends or those 2 to 3 times a year the market's healthy. And I like to try to trade that. They usually last about 6 to 12 weeks. So that's that whole line. You make 80% of your money in 20% of the year. It involves some patience. It involves putting in the work and identifying when things improve, because I want to try to invest or trade anywhere from a few weeks to a few months of holding swing trading stocks. I want to do that when the wind's at my back. And as William O'Neill said, 4 out of 5 stocks, and maybe said 3 out of 4 stocks move with the general direction of the market. So when the wind's at our back, I want to be involved when the general direction is in an uptrend.
Yeah. And I did misspeak. I accidentally credited CNBC. It's actually CNN that has that fear and greed.
The CNN fear and greed
index.
Yeah, that's right. Yeah.
I was just thinking CNBC because of markets, but CNN deserves the credit for that fear and greed index. But go ahead and talk a little bit about this. Now, this is Marty Zweig breadth thrust, and these are signals since World War II. This is data that you got from Ryan Dietrich that posted a lot of this from Carson Investment Research, Ned Davis Research. What are we looking at here? What is the breadth thrust?
So it's interesting that it combined with the follow-through days we had on April 22nd and 23rd on the NASDAQ. Anyone can just Google or go to Investopedia to get the definition, but the gist of it is, over a 10-day period, an incredible surge in buying from the institutions. So the biggest takeaway here is that line that the big institutions control the markets. That's bottom line, period, end of sentence. The big pension funds, hedge funds, mutual funds that are trading hundreds of thousands, if not millions of shares, they control the market. So when they are distributing stock and selling consistently, I want to get out of their way. And when they are buying, I want to pay attention to that. So the bottom line here is the Zweig breadth thrust, invented by Marty Zweig, is that surge in buying over a 10-day period. It's only happened 19 times since World War II. So it's something to pay attention to, a rare signal. And every time, 12 months later, the market's been higher. So it's important because it's rare and it's also been consistent when it happens. But the whole point is it was a surge in buying that also coincided around those 10 days from mid-April, whenever it was, those 10 trading days, when it also coincided with the 2 follow-through days that we saw. Yeah.
And just to, put an exclamation on that point, the average and median right around 23 or 24, 25%. So as much as you said, don't expect much after 2 25% back-to-back years, we could be looking at, because of the breadth thrust, potentially, another big year.
It's possible. Yeah, I was just, my whole point was of just keeping the expectations realistic after back-to-back 20+% years. I hope we get another 20+% year, and it's possible we could. Anything is possible. But my whole point of that was to expect some digestion. But again, this shows out, time frame being the key word here, this shows that 6 to 12 months from now, from that breadth thrust, which would take us to about October to next April, is when you can expect it higher. And to your point, if the S&P average does about 8 to 10% a year, depending on dividends, the fact that it's more than double that and an outsized gain is something to really pay attention to.
And also, sometimes people forget that in order to get that 25%, it's not a nice straight line up. There's a lot of, that's just taking from one point to another point. When you're looking at 12 months, there can be a lot of movement in between.
Yeah, well, you can see 3 months later, sometimes the market's flat to down. So
right. Yeah.
Great point. It's never a straight line. The market is designed to fool the majority of people. All those quotes, it's never easy. So again, remind yourself of the time frame and also accept there's going to be pullbacks and normal corrections along the way.
Absolutely. Now, there's another rare signal. So it's and you were telling me that you had like 7. You chose 3, but there were all of these
there were a lot.
unusual signals that all kind of happen at the same time. So this is, I didn't know what else to call it except for a 3-day jump.
Yeah, this is 3 consecutive gains of greater than 1.5% on the S&P. As you can see there, what, 9, 10 times? It's very rare. It also coincides with the breadth thrust, coincides with the follow-through days. The bottom line, again, if anyone wants to take anything away from this, the big institutions control the markets, and they came back in aggressively in the second half of April. And it's very rare you get 3 consecutive gains. Tying it into psychology, a lot of sentiment measures, CNN fear greed was at 3. That's measured from 1 to 100 or 0 to 100. It was at 3, which is fairly putrid sentiment. NAIM, the active investment managers, all across the board, a lot of different sentiment measures showed people fearful, reducing exposure, buying puts. And it's amazing that when everyone throws in the towel, the market just comes back, and you usually get these incredible gains when people are caught off guard in cash or short. And that's when it's a rare signal, again, leads to gains 12 months from now.
Yeah. And it's worth noting that a lot of times, I like that this is using a 3-day, because a lot of times people will point to 1 day. And certainly April 9th, being up over 12% in a single day is notable. And I think that was the third biggest percentage gain. President Donald Trump mentioned how it was the best day ever. Point wise, yes. I think if you look at percentage gain, I think it was the third. So right up there. But a lot of times those do happen around volatility. And there was a lot. I mean, what were we down like 5 or 6% the next day? But this is different because it's looking at 3 consecutive gains of 1.5% or more.
And that's goes with the concept of a follow-through day is you ignore like those 1 or 2 day bounces. So when you get 3 consecutive, and it's not exactly, 1.5%, so collectively over 4.5%, 5% at least, that's a pretty nice surge in buying of, again, maybe facts changing, people getting too negative, but the whole point is a huge surge in buying.
Right. And since you mentioned the follow through day, it's probably worth putting that signal in here as well. Just for people that are maybe not aware, what we look at is we look at a low and then we need a rally day. Now, sometimes we will choose what we call a pink rally day, where the day didn't close up, but it closes in the upper part of the range. And so we did get that on this day. This day didn't count because it was too early. That was day 3. And then you kind of doodle around. But this day right here, April 22nd, April 22nd, we had a gain of over, well over 1%. Volume was heavier than the day before, both on dollar volume and trading volume, I should add. And then you got another strong day. So back-to-back follow-through days the next day. So that's our follow-through day concept that we're talking about. And again, why you got the nickname Follow Through Day Fahmy is because you seem to just waltz around right around that time. And this day right here, while not a follow through day, it had all of the elements of it. So you were close.
I try. But I'm glad you pointed that out because, again, follow through days combined with the 10-day Zweig breadth thrust, the 3-day indicator, advanced decline on all of NYSE. There was so many different measures. The whole point, though, is signs of the institutions coming back in. And when they come back in, you have to respect that. If you're short and you hate the news, you hate the politics, you hate whatever's going on, COVID, whatever the case may be, you're supposed to ignore that and what's the line? Pay attention to what the market's actually doing, not what you think it should be doing. So that's where paying attention to facts and paying attention to what the institutions are actually doing is very, very important. And at the time, it's hard to shut that out when the emotions are swirling and so forth.
Yeah, I mean, to your point, that 2003 time period that you were talking about earlier, it's not like all the news was rosy. We were about to go to war in Iraq and, weapons of mass destruction, potentially blowing up oil fields. Saddam Hussein is a crazy man. There's always those elements.
And talk about time wearing on people, 36 months from March, April of 2000. I know we technically bottomed in October of 2002, but whether it's, you want to call it 30, 36 months of just, you had 9/11 happen after the dot-com collapse. That is talk about wearing on sentiment. And people at that point just threw in the towel, and then all these stocks set up, and then the facts change. That's why, as O'Neill said, be ready. Spring's around the corner, and be ready, and always be ready for that, because there will always be new opportunities, especially coming off of those big bear markets.
Yeah. And I mean, look, some people didn't have a choice but to throw in the towel because they didn't have any risk management. They got over levered and they basically lost it all. And, they couldn't come back from it emotionally or with their capital because of how much they lost.
Yeah,
you got to remember the NASDAQ itself was down 79% from its peak. I mean, that's not nothing.
Yeah, you don't have to manage risk if you don't have anything to manage. I guess that's
right. There you go. It's just that simple. I wanted you to also, before we kind of switch gears here, this 6-day Whaley signal, and I hope I'm pronouncing that last name properly, Wayne Whaley. He looks at 6 days, and whether it's 4 of 6 days up 0.5% or 3 of 6 days up 1.5%, this is another signal that just doesn't happen that often. But we got it on April 25th.
Yeah, it's a spin-off of that 3 up days. So it's when 4 of the 6 are up at least, and 3 of the 6. And again, it's just, the basic concept. If anyone hopped in late, big institutions come into the markets, breadth thrusts, various thrusts, advanced decline, follow-through days. And what they do is, same with this one, 12 months down the road was 30-1. The only time it was down 12 months later, as you can see there, was 2001. To your point, a 36 bear market where you had 9/11 happen later that year. So that's a very, very rare 36-month bear market, 2.5, 3 years, whatever you want to call it. But I'll take 30-1. That's like you from the foul line, right?
Right. Exactly.
I was going to say 3-point line, but that'd be too aggressive.
Yeah, I think, let's not overstate.
That'd be Steph Curry territory. But yeah, right. I'll take 30-1, 30 out of 31 times higher. So a year later. So
yeah, no, absolutely. So switching gears a little bit, you've brought up some analogs here, 2003, and again, rightly noting the 2004 pause, which at the end of the day, the 2004 pause wasn't a disaster. There was this little known company called Apple, right, that was basing during that time and came out in 2004, while everything else was kind of basing. So you also shared some charts with some analogs, and I thought this was really interesting. So I want to share these as well, because a lot of people are talking about the similarities with AI and the internet, and there's been a lot of talk about this, but I like how you kind of put it towards some actual numbers here, and kind of let's look at how it traces to an event, and in this case, an invention, a technology.
Yeah. This is from Bespoke Investments, and when I saw this, I just thought it was fascinating, because I've talked on IBD Live and in previous podcasts about what fuels bull markets are inventions, things that revolutionize and change our lives, whether it's the railroads back in the 20s, or television, airplanes, drug discoveries, PCs, smartphones. The list is endless. The more recent analogy is the internet. New invention, revolutionizes our lives, and what do all of these things have in common is increasing productivity as well. So simple example, railroads getting from New York to LA took faster than walking, clearly. So the internet set up productivity, and the internet, as far as a major invention in recent memory or recent years that revolutionized our lives, led to an incredible bull market from roughly 1995 to the early 2000. So as I continue to digress, the analogy is, what's the new, amazing invention of the time, which people way smarter than me, and I know that's a large sample size, people way smarter than me, Mark Andreessen, people like that, saying that this AI and artificial intelligence is going to be bigger than the internet. So the analogy is, if you have a new invention and it roughly started around 2022 to early 2023, it's very, very possible that this could be, again, another, history could rhyme with another really nice 5-year bull market. However, you've made this point earlier, it's not going to be straight up. There's going to be incredible corrections and volatility along the way. It's not going to be a smooth ride, just like from 95 to 2000, you had a major correction in 97 with the Japanese debt crisis, and then in 98 with the Russian debt crisis and long-term capital blew up. So if you fast forward to today, you're going to have a hiccup with tariffs, and maybe a year or two from now, you might have another big pullback as well. So, but this was fascinating because it was tracking the NASDAQ after every Netscape release with ChatGPT release, comparing the original internet browser with one of the leaders in AI as well. So AI applications. So I don't know. I mean, I find it fascinating. I'd love your feedback on it.
No, absolutely. And for a while there, we were actually kind of looking at this this most recent period and kind of lining it up with 1998. But look, I mean, this is tracking pretty close. I mean, you got to remember, things don't track exactly, when you put these charts next to each other. But if you can kind of see, oh yeah, it's tracking close, it does give you a sense of the potential, and I think that's worth noting. And as you said, look, we had kind of a period in there in 96, 97 that was a little rough, and of course, at the end of 97, again in 98. So it doesn't mean that it has to be smooth sailing the whole way, but there's a lot of potential here. And it was interesting too, because Netscape came out, and I'm thinking of that big N before Netflix, right? They had the big N, and using the Netscape Navigator, but there were also a lot of companies that were coming out and huge gains. AOL, of course, but there's also these companies that no one remembers anymore. Mindspring Enterprises, I remember trading that one, and there's a whole host of them that just went out of business.
Competing browsers with Lycos or search engines and all that stuff. Yeah.
Right. Ask Jeeves. When was the last time you used Ask Jeeves? So sometimes, ChatGPT is out there, and we have kind of a lot of people fighting for top dog status, and we don't know who that is going to be. And in some ways, we don't even know the power of AI, just like we didn't know the power of the internet in the late 90s. There were so many things between mobile apps, phones, everything like that came later. And who would have thought that in the 90s that things were going to be the way they were 15 years later with social media and everything?
Yeah, that's a great point, because it's not just that boom from 95 to 2000. There were so many inventions and things connected where you had, Dell, Microsoft, Cisco, Intel. Those are some of the big four that made the PC leader, the software leader, the chip leader on the PCs, and Cisco connected them all. So you had that as part of the fuel with a lot of the internets and browsers and search engines, and as well as Nokia and Ericsson with smartphones becoming more prevalent. I mean, so there was a whole bunch of things with communications and with technology going on. But I really want to hammer this point, which we just made, is that from 95 to 2000, there were several corrections and scares and growth scares along the way. Sound familiar? Where just, a few months ago, there were growth scares with AI until Microsoft and Meta came out with their most recent earnings saying, nope, we're still spending, we're still full steam ahead. So there's going to be shakeouts. It's not meant to be easy. It's not meant to be X equals Y with a straight line up where we just sit back and everyone makes money. It's going to be, if this is going to be a similar analog, there's going to be a lot of shakeouts along the way. And before I forget, one other thing is, moves in the markets go on way longer than we can expect. Because someone might say, are you saying we're just going to go nuts for the next 2 or 3 years? I'm not saying anything. I just know in both directions, just when you think things can't go higher, they usually do. And in bear markets, when you think things can't go lower, they usually do. So just keep in mind, the market moves tend to be exaggerated in both directions.
Yeah, and as a reminder for folks, you look at this chart. I can't remember when exactly, but it was in 1997, at the end of 1997, I believe, that Alan Greenspan, the maestro of the Fed for many, many years, gave his irrational exuberance speech. And while there were corrections there, and some letting the air out of the bubble, I would argue that there was maybe a little bit more irrational exuberance to go.
Yeah, didn't when he gave that irrational exuberance speech, I think the Dow, he was talking about the Dow, I think it tripled after he gave that
Yeah,
speech. At
yeah,
least
so,
two or 2.5x. So
yeah,
that just proves the point. That just proves the point. Moves get exaggerated. A really quick story. I remember a friend of mine, CMGI was another name, that internet
yeah.
incubator. Split adjusted, it went from 1 to 120. And it was actually, this guy was a famous big hedge fund manager. And he told me this is a zero. And you know what? He was dead right. It went from 1 to 120 and it was a zero. The problem is it went to 360 before it went to zero.
Right.
So the analogy again is, I mean, split adjusted, a thing goes up 120x and then still triples after that.
Yeah.
So he was dead right, but the timing was not right because, again, moves get exaggerated. So
Yeah.
just keep that in mind, and keep things in perspective. And another thing is in How to Make Money in Stocks, which you helped mark up, the fourth edition. You can study some of those past winners to help give you a little bit of perspective.
Yeah, I'm glad you brought that up because I threw in this slide. This is from page 389 in How to Make Money in Stocks, the fourth edition. Actually, in the third edition, in the Successful Investor, Bill wanted to put this chart in. Mike Webster, had kind of noted this similarity. I put the chart together and it was like so close. This is 1920s, the Roaring 20s. Versus the 1990s. And again, it got even more exaggerated on the Nasdaq when you line those up. Came down in a very similar way. The Dow corrected 89% in the after the 1929 crash, whereas the Nasdaq came down 79%. And then you had a really great run. Now you didn't kind of follow after that because in the late 30s you had this guy Hitler kind of messing things up in terms of the global world order. But we are beyond this. But it's interesting how sometimes this stuff repeats. I was kind of thinking back to what some of the things that Bill told me, and his dad was a RCA salesman, and of course radio was a big thing, back in the 20s, and commercial radio broadcast. So to your point on communication, a big thing there. Your point on the railroads and what that did. I mean, you started having in the airlines. Wright Aeronautical was a big a big company, a big stock move around this time. So there's definitely a lot of similarities. The stocks, they look very similar. The names change, the technology changes, but there's a lot of similarities there.
Yeah, no, weren't there like 300 railroads that went crazy and then only like 5 or 10 survived, just like there were, to your point, 300 .coms that no one even knows about, but the AOLs and eBays and a handful of them survived. So it's literally
same thing happened. Same thing happened in the auto industry, right? There were hundreds of auto companies, and then it got down to 5, right?
Yep.
You had the big 3 here, and then you had Honda and Toyota and a few others, but it was very consolidated. And now with EVs, you're kind of swelled up again. You're back to hundreds of different car companies. Each
this is also a chart of my blood pressure trading in the 90s. I remember that too. So.
Yeah. I could see that.
I can see, that's what I thought of. So
So if anyone else in YouTube that is watching live, if you have some thoughts about some of these analogs, I'd love to hear them. We've got some folks that one guy is it's midnight in Italy, and he's like, well, I don't care that it's midnight. I gotta watch Joe Fahmy. I'm gonna stay up late for that.
Thanks for digging out the one nice comment. I appreciate that.
Oh no, there's plenty. There's plenty.
I'm kidding. I appreciate everyone's kind words, and I'm hopefully they're getting some nuggets from our discussion.
Yeah, I also wanted to take a moment because 2 years ago, Of course, we lost Bill O'Neill, the founder of Investors Business Daily. As Joe said, I worked very closely with him. I marked up a lot of those charts. And one of my prized possessions is the third edition of How to Make Money in Stocks, because in here were kind of all his notes to me about what he wanted to do for the fourth edition. So on this page, here were the 100 charts that he wanted in the front of the fourth edition. And then he even had, in certain spaces like, oh, I want to make these charts bigger. So he kind of outlined, oh, this is where we can find some space. If we just cut out this part. And he really liked filling up stuff. So he saw this last page that's the cover of the book, and he put 3 letters here: use. He wanted to use this back cover to do something, not the back page, but the actual cover. He's like, why is this white? We should use this. So I wanted to just give a quick remembrance, because Bill O'Neill, of course, was important in my life and so many lives in terms of what he shared with the paper and his whole system of investing.
No, that's awesome, and thank you so much for sharing that. I know you work closely with them, so that's much appreciated.
Yeah. Okay, let's get into some stocks. So where do you want to start? You brought some stocks along, and there's this little stock called Nvidia that had earnings. That we can maybe we start there, because there is certainly in terms of chips. That is a big one, right? For the chip makers. Here is the after hours right now. This is on my Thinkorswim platform. I think I hit all my account numbers and everything, but here was the day. It was kind of a ho-hum day. This is a 15-minute chart. Earnings came out. We got the conference call. It might be going on right now, but a pretty good reaction. So Nvidia's been this big winner. Do you hold through earnings? Do you just wait? How do you handle it?
I mean, to the point I made earlier, after a stock or a market makes a big move, it's not a surprise to consolidate. It's been going sideways for about a year. Mm-hmm. So let's not forget, split adjusted, it went from whatever it is, 10 to 150 with many corrections along the way. And when you look at the weekly chart, it's just been consolidating between that sort of 90 to 140 for a long time. But that's actually pretty normal considering the explosive move off of, when it really had that insane earnings in May of 2023. That was the first time where 30-something analysts were following it, and they weren't even close.
Yeah,
that was like it was one of the greatest beats as far as numbers wise in the history of Wall Street. So since then, I think it was around 200 at the time, 10-for-1 split. So 20 to 150. That's since that earnings, to digest for a while is perfectly normal. Now it's widely held. It's one of the top market cap names. I don't think the growth story's done. They're growing at a slower rate, but still the growth is insane. Jensen Huang's one of the best CEOs on the planet and is one of the best visionaries. And, they're worried about Blackwell sales when he's already thinking 2 or 3 more products in the future right now. So I think it'll do well. And if this bull market led by AI continues, I think it can do well, over the next year or so. But probably still going to be in this range and consolidate for a little bit. But at least the strong earnings is good.
Yeah, absolutely. Another kind of AI darling right now is Palantir. Palantir Technologies. I do have a position in this. I forgot to mention that in case you forgot, Joe, we're going to disclose anything we have
Yes.
positions in. So Palantir Technologies, PLTR. This has been another one of those with just a phenomenal move since 2023. Pretty deep base here, 47%, but shook it off pretty quickly.
I was going to ask you, do you forgive a deeper base when you don't want it to go much more than, let's say, 30? Do you forgive that because of the velocity of the correction in the markets?
Yeah, I mean, you have to put it in the perspective of what happened in the market. And to your point, in 1998, that long-term capital management, fiasco. I'm just going to go back there real quick. I'm going to go to 1999. Oh, I have to we did this, Charles and I, after last week, because you had this really kind of ugly base right here with Charles Schwab, 40% deep, but the handle 27% deep for a handle. That's very unusual. But if you put it in the perspective of what the NASDAQ did, the fact that the NASDAQ undercut and Charles Schwab didn't, I mean, can you forgive a 27% handle because of that?
Yeah, that's
Because
not
it
a
held
big
up
base.
better.
That's a big handle.
Yeah. and look, that happened in 2009 too. There were a number of stocks that when the indexes took another leg down, they held up. Apple, held up pretty good. Booking, it was Priceline at the time. Look at that. This was the move down that the market had, and this was already on its way back. So sometimes it's not just the depth, but it's kind of how it comes out of it to me.
Yeah, that's a
So
great point. So Palantir, and I'm glad. Thank you for answering that and clarifying it for my own knowledge. But Palantir, yeah, it was a deeper base, but the velocity that it came back towards those new highs, I thought was very, very impressive. As far as bouncing back, where it's right back towards those highs. So I like that it's one of the leaders in AI, and the earnings and sales are strong, profit margins are strong. There's a lot of bullish options activity, good bullish flows going out into year end. And I think it's consolidating well. It pulled back to its 21 day after the earnings, made a new high. It's just been consolidating now. I think it's acting well. Full disclosure, I do have a position. I own a position for my money management clients. So all three of the stocks I'm mentioning, by the way, I do have, before I forget, I do have positions in all three of them. But I've been in this one since it gapped up back, got back into it when it gapped up back above the 50-day in the low 100 range. And I've been in it. I have a full position, and I'm going to try to play it out as far as my time frame, into year end and see what happens.
Yeah, that's when I was buying it as well. I did scale out a little bit ahead of earnings, but then I was buying it back. And sometimes I have to sell things when we put it on Swing Trader, and then I have to wait 30 minutes and then buy it back. So
yeah,
but yeah, I was buying it just as it went through 100. It looked pretty powerful there.
But yeah, I think it's again understanding. The more you look at charts and understand history, a big run up. Maybe buy the rumor, sell the news. Even though the earnings were strong, it pulled back. But look where it pulled back to. Pulled back to the 21 EMA, that green line there, and then a nice consolidation so far. I think the price action is pretty good, and I still like this one over the next, probably 3 to 6 months into year end, and then we'll assess it from there.
Mm-hmm. You mentioned how dynamic CEO Jensen Huang is. Palantir has its own kind of rock star with Alex
I'm
Karp.
jealous of his hair.
Right? Is that an element for you? Do you kind of look at the I don't know, sometimes the cult of personality behind a CEO, not just the personality, but again the ability to deliver and motivate and really kind of share the vision, as some of these CEOs are able to do.
Yeah, no, if they're brilliant and it's tough though, because sometimes you can have a brilliant CEO that's not great at managing the business, or
Right.
So you either need one that's good at managing the business or surrounds, him or her surrounds themselves with a great team that helps to supplement their vision. So
Yeah.
I'm again, management is definitely key in this, and the management's strong here.
Yeah, it's sometimes recognizing their own weaknesses and being, I guess, humble enough to hire to supplement those weaknesses sometimes, for some folks. Another one that I do have a position in this as well, Dutch Brothers, or Dutch Bros, I should say. I've never been to their coffee shop, but I just hear a lot about it, and it really seemed like the retail restaurant group yesterday was on fire. I mean, you had Cheesecake Factory up 5%.
Yeah,
Texas
Wingstop, Shake Shack,
Shake
Texas
Shack, yeah.
Roadhouse.
I mean,
A
just
lot of these.
you name it. It was
Yeah.
huge moves yesterday. And look, for the most part, they retained those moves. What did you think of Bros, and why is this one interesting to you?
So I like the concept of one of the what's the word I'm looking for? Categories or sectors of big winning stocks is retail.
Yeah,
And it's not
absolutely.
just retail clothing and apparel, it's retail restaurants. So if you can have a concept like a Panera Bread, which went private, but that thing went from split adjusted 4 to 300 and something before they went private. When it came out of the '03, I believe, bear market. Anyways, my point is, if you have a concept and you can replicate it, whether it is Chipotle or McDonald's or Panera Bread, I like that. Starbucks, obviously. So in studying that blueprint, I'm trying to find the next one. Their conference call recently, they have about 1,000 stores, and they used an expression 2029 by 2029. And what that means is they want to grow to over 2,000 stores by 2029.
Wow.
So they're mostly concentrated on the West Coast and Northwest and so forth. But I like the whole concept of big winners can come from fast casual, from restaurant space. And number two, when you have a concept that proves itself and then you can replicate it domestically, and in the case of McDonald's, internationally, even things like that. I like that for potential big winners to stick with for longer term. Again, full disclosure, I own a position, and this is one I just think can do well, longer term, not just 6 to 12 months, but longer term. And again, you can see with corrections along the way. The thing went from 80 down to below 50. It's going to build. If it's, let's say it does go higher in the next 3 years, it's not going to be straight up. It's going to have your normal corrections and pullbacks when the market corrects and so forth. But longer term, I do like this one.
Yeah, no, absolutely. And, that expansion thing too, when I see something that's only in 18 states, hey, there's there's a lot of states left. Now maybe you're not going to go to Alaska, but there's still a lot of states.
32, and if Canada becomes the 51st state,
there you go. Yeah, so you can
Canadians
really,
hate that, by the way.
there.
So I just upset an entire country. But
one more stock for you. Let's take a look at Rocket Lab. I thought I had a position in this, and I don't, but with SpaceX, and everything that's going on with space, and not just, again, it's not just about the space exploration side, but here again, we're kind of in that communication side where you're getting these payloads of satellites up there, and what that does for communications. What is it about Rocket Lab that is kind of exciting for you?
Yeah, I mean, I've been in this for a while, and I identified it. I even put it out for free on my blog at joefahmy.com, and there was a high tide flag at $10 in October. So, and I've been talking about it for my educational members since $5. And I full disclosure, I have a position, and it's not. I mean, it's speculative. And again, when you play something longer term, it's not going to be easy. As again, this thing corrected from over 30 down to 15 recently. And at least it held the black line there, the 200-day. But most of their stuff has been with their Electron rocket, which, to your point about payloads, it can only handle a certain weight. Their new Neutron rocket, which is coming out the second half of this year, is going to be competitive with SpaceX to be able to carry some of the larger satellites and larger projects and so forth. Barron's has called this the next closest competitor to SpaceX, even ahead of Boeing. And I honestly think if anyone has a time frame of more than 7 seconds, this is like a 2027, 2028 story. They've executed everything they've said so far. I like it. I think it has huge potential. If SpaceX's last round of funding was around $350 billion, and this is trading at $13 billion market cap, I'm not saying it's going to catch up to that, but even if it does 10% of SpaceX's market cap, I think it has potential again in the next 2 to 3 years, even though most people want something for the next 2 to 3 minutes after hours to trade.
Right.
I'm just putting things in perspective with a lot of these ideas. They're either 3 to 6 months or longer.
Yeah. And to your point on the payload side, they just made, I don't know if it was yesterday or the day before, they just made a recent acquisition.
After
I'm
the
not sure how
close
to pronounce
yesterday.
it.
Yeah,
it was yesterday. Okay, Geost, with that electro-optical and infrared payload manufacturer. So yeah.
Yeah, it was cash in stock, but the market seemed to like it because it was up after hours, and the market was down today and it just showing relative strength. I could see a handle being built here as people who might have got in around 30 and they got buried in it. That's kind of what creates the cup with handle. Maybe they come back up, creates a handle. And again, just have a little patience.
Yeah. No, great stuff, Joe. It's always a pleasure to talk to you. And I just want to make sure that you know that it wasn't just Italy giving you a shout out. There was also Belgium and Taiwan. A lot of folks really appreciate your insight. And I really want to make sure that people know how much education you give out there. You've got a great podcast yourself, Happy Hour, Joe's Happy Hour. You just had Mike Webster on, what was it, 2 weeks ago?
Yeah.
Really kind of diving deep with Mike. And you've got just like this, such a fascinating guest list of all walks of life, some Hall of Fame musicians talking about option investing and just crazy stuff. So great stuff there. You've also got your blog, joefahmy.com. Man, what am I missing? Oh, your tweets at jfahmy. A lot of great information there. You just really share a lot of that wealth of knowledge that you have. And I appreciate
thank you so much for the kind words. I enjoy this. I'm passionate about it. I love talking markets. If I can find some fascinating people to talk markets with, and if I can try to do my best to pass along some of the knowledge and explain things, because the O'Neill book is 300-400 pages with an insane amount of content. And you have to read it and reread it and go through the charts and reread it and then trade the markets for a couple of years. Oh, yeah. And then come back to it, read it again and say, I need to refresh myself. The learning curve is a lot. And if I can help, and I know you guys at IBD Live and your team there and all through all the different platforms and content you do there, I know you try to help with that as well. But if we can all help to speed up some of that learning curve for people, then mission accomplished. So I hopefully I'm helping with that as well.
Absolutely. And I gotta say, you're also a great host. I was out in Vegas in February. Joe took me out to dinner along with a very interesting array of people that you collected. Just a fabulous dinner. It was one of those things where I got back to my hotel and I knew my wife was asleep, and so I had to call my daughter in Hawaii because I knew that 3-hour time difference. I could chat with her about it because it was just such a fun night. So
ironically, the magician friend of mine is on the podcast coming up this Saturday.
Oh, really? Okay, this magician was just amazing.
I'll send you the link. He does a few.
I will definitely watch that. So yeah, Brian Shannon and I were trying to figure out the pattern of these cards that he had, and it wasn't until Lindsay, one of the other guests, said, wait, that's my phone number in the cards. And I'd be like, oh, okay, that's something completely that we were not expecting.
Yeah, so, the mentalism and the magician. I love that stuff. And like I said, I'm blessed to know some great people and try to bring some of those conversations and personalities to life through the podcast. I'm having fun with it. So
yeah. So again, Joe, thank you so much for all that you share, and thanks a lot for being here today. Really
thank you for having me, and thanks for the audience for tuning in. Really appreciate it.
Okay, great. That's going to wrap it up for us this week. Don't forget, we're going to be back next week, live at 5 with Mike Webster. So Joe Fahmy just had him on, and we're going to be diving into ATRs because it's one of those things that Mike is really trying to make a push for, changing the perspective from percentage gains to ATR gains. So we're going to dive deeply into that topic next week. Hope you join us. Thanks for watching this week. We'll see you next time.